All right, buckle up, because we're time traveling back to 1988 for this deep dive.
Back to the
Yeah,
80s.
we're taking a look at Warren Buffett's letter to Berkshire Hathaway shareholders from that year.
Oh, 1988.
Yep, 1988. Big hair, shoulder pads, and let's not forget some serious market jitters after that Black Monday crash in '87.
Makes sense.
So we're going right to the source, Buffett's original letter, and we're going to see how he navigated all that.
I'm in.
Cool. So right off the bat, Berkshire saw a 20% growth in net worth that year. Pretty impressive, right?
Yeah, no, it is. But what's really interesting is how Buffett frames that growth.
What do you mean?
He actually compares judging Berkshire's future based on past performance to, like, evaluating a baseball player, like a 42-year-old player, solely on his lifetime batting average.
Okay, I'm liking this analogy already. So what's the point he's making?
Well, he's saying, don't get too caught up in the past. You know, you got to look at the current context, the fundamentals of the business.
So past success doesn't guarantee future returns. Got it.
Right, exactly.
So even with a 23% annual growth rate over 24 years, Buffett's not, like, kicking back and relaxing.
Not at all. He's actually calling a growing capital base a good problem, but a problem nonetheless.
Okay, how's that a problem?
Well, because you need to find ways to deploy that capital effectively as your resources grow.
Makes sense. Can't just sit on a pile of cash forever.
Exactly. You got to keep putting that money to work.
Now, speaking of putting money to work, he talks about these 7 standout businesses in Berkshire's portfolio that year.
Sainted 7, right?
The Sainted 7, yeah. What made these companies so special?
Well, these were companies like, Buffalo News, See's Candies, Nebraska Furniture Mart.
Big names.
Yeah, and they weren't just successful. They were knocking it out of the park.
Okay, so what was their secret?
They had, get this, a 67% return on average equity capital.
Wow, that's huge.
Yeah, it's remarkable. But it's even more interesting when you consider that they each did it in their own way.
So no one magic formula.
Right. Each of these companies had its own unique approach.
Okay, so give me an example. Like, how about Mrs. B at Nebraska Furniture Mart?
Oh, yeah, she's a legend.
She is.
She built that business into a powerhouse. Just relentlessly focused on value for the customer.
She knew what people wanted.
Yeah, and she catered to them better than anyone else.
Okay, and what about Stan Lipsey at the Buffalo News? He managed to, like, increase profit margins while most newspapers were, really struggling.
Yeah, it's pretty amazing. He completely defied industry trends.
How do you do that?
He doubled down on quality journalism, He adapted to a changing media landscape.
So not afraid to make tough choices.
No, not at all. He really understood what made the paper valuable to its readers.
Sounds like both Mrs. B and Stan Lipsey were really strong leaders, knew their markets really well.
Absolutely. That's a key takeaway for sure.
Now, Buff also gets pretty fired up about accounting in this letter, right?
Oh, he doesn't hold back.
He doesn't.
No, he calls out managers who manipulate GAAP to, present this misleading picture of their company's performance.
Okay, so what's his issue with that?
He compares them to thieves, basically.
Wow, okay, strong words.
Yeah, he's not messing around.
So, besides calling out the bad behavior, what's his message here for investors?
He's really advocating for transparency. He wants investors to look beyond the surface, ask the right questions to understand a company's true value.
So he's not just criticizing. He's trying to empower investors to make good decisions.
Exactly.
He even gives us 3 key questions to ask.
He does, yeah. They're actually still really relevant today.
Interesting. Okay, well, speaking of an industry that sometimes gets a bad rap, let's talk about insurance. It was and still is a core part of Berkshire's business.
Yeah, insurance.
And in 1988, they were dealing with, like, low profitability and, kind of a negative public perception.
Yeah.
Buffett actually compares it to, get this, the breakfast cereal industry.
Breakfast cereal.
I know, right? He says people accept price hikes on cereal without, batting an eye, but they get outraged when insurance premiums go up.
It's true, though.
It is. It's funny, but it makes you think about how we perceive value, right?
Yeah, totally. It's about how we react to price changes in different contexts.
So it sounds like Buffett saw some trouble brewing in the insurance industry back then. And
Oh, yeah. He actually foresaw problems with initiatives like California's Proposition 103, which was aiming to force prices down below cost.
Sounds familiar.
Yeah, it does, right.
So how did Buffett navigate all of this?
He did what he does best. He stayed disciplined, stuck to his principles, refused to write policies at a loss, even if it meant lower volume in the short term.
He was playing the long game.
Always.
All right, well, let's shift gears now and talk about his investment strategy in 1988, because there's a lot to unpack there.
Sounds good to me.
So in his letter, he talks about these permanent holdings, things like Capital Cities ABC, Geico, and the Washington Post.
Yeah, those weren't just stocks he was trading.
Right, they were companies he believed in.
He was in it for the long haul, years, maybe even decades.
That shows real conviction.
It does. A lot of patience, too.
And that year, he makes this big bet on Coca-Cola, right?
He does, yeah.
What was it about Coke that caught his eye?
Well, it was a classic Buffett play.
Hmm.
A strong brand, global reach, a product that, people loved it.
Yeah, Coke was everywhere.
Exactly. And it had this history of consistent earnings.
So it ticked all the boxes for him.
Pretty much.
Now, he also talks about arbitrage in this letter, which is, I don't know, it's always kind of fascinated me.
Yeah, arbitrage, it's interesting stuff.
It's like bargain hunting, but on a, massive scale.
It's more than just finding a good deal, though.
What do you mean?
It's about exploiting these temporary price discrepancies between different markets.
Okay, and Buffett uses this. How?
It's a way to generate returns when they have more cash on hand than good investment ideas.
So it's like finding, I don't know, these hidden pockets of value.
Yeah, exactly. You're finding value where others might not see it.
And he even tells this story about a cocoa bean arbitrage opportunity he jumped on back when he was 24.
Oh, yeah, the Rockwood & Co. deal.
That's the one.
It's a great story. It really shows his knack for spotting unusual value, even in something like cocoa beans.
So he's had this talent from a young age.
Seems like it, yeah.
But, even he acknowledges the risks involved, especially in a, heated market.
Oh, yeah, he was definitely cautious, especially about, the excesses he saw in the takeover market at that time.
He even foreshadows the junk bond crash that was coming.
Yeah, pretty incredible foresight.
Now, one of the things that really grabbed me in this letter was his critique of the efficient market hypothesis.
Yeah, that was a pretty bold move.
He basically says, not so fast to this, widely accepted theory.
Well, the efficient market hypothesis suggests that, markets are perfectly rational and they reflect all available information.
Right, like everything is priced in.
Yeah, exactly. But Buffett argues that that's not always the case.
And he uses some pretty strong evidence to back that up.
He does. He points to the long-term success of, Graham Newman, the Buffett partnership, and of course, Berkshire Hathaway.
All built on value investing principles.
Right, which directly challenge this idea of efficient markets.
And he makes this comparison, right, between the hypothetical 10% return predicted by the efficient market hypothesis
Yeah.
and the consistent 20% plus returns achieved by these partnerships over, decades.
And the difference is, it's mind-blowing.
Yeah, it is. He says it's like $97 million versus $405,000 on a $1,000 investment.
Those are real-world results,
It's hard to argue with that.
It makes you wonder why so many people still cling to the efficient market hypothesis.
Yeah, you have these clear counterexamples.
It's a complex issue, but I think part of it is that, the efficient market hypothesis offers this sense of order, predictability.
It's comforting.
Yeah, it's comforting to believe that markets operate rationally and efficiently.
But Buffett's success really throws a wrench in that, doesn't it?
It does. It shows that there are still opportunities out there for those who are willing to do the work.
To think for themselves.
Exactly. You don't have to blindly accept what the market's telling you.
You got to challenge the conventional wisdom sometimes.
Absolutely.
Now, in 1988, Berkshire makes this kind of interesting move. They list their shares on the New York Stock Exchange.
Yeah, that was a bit unexpected.
It was. They generally prefer to stay out of the limelight.
They do, so it seems strange at the time.
But it was a strategic decision.
Oh, yeah.
Buffett wanted to, reduce transaction costs.
Makes sense.
And attract these long-term shareholders who aligned with Berkshire's values.
Yeah, he wasn't interested in, the short-term speculators.
No, he wanted investors who were in it for the long haul.
Exactly, people who shared his vision.
He even says, that he's more concerned with intrinsic business value than maximizing share price.
It's a refreshing perspective, especially today when so much emphasis is placed on those, short-term gains.
Yeah, quarterly earnings reports.
Yeah, all that. He was building a company for the long term.
And he wanted investors who were on board with that.
Absolutely.
Speaking of long-term vision, he also includes this really touching tribute to David L. Dodd in this letter.
Oh, yeah, his teacher.
Oh, co-authored Security Analysis with Ben Graham.
That's right.
It's a great reminder that even the greatest investors build upon the wisdom of, those who came before them.
Yeah, like even Warren Buffett had mentors.
He did, and he acknowledges the impact that Dodd's teachings had on his own, investment philosophy.
It's about continuous learning.
Yeah, and seeking out those diverse perspectives.
Now, as we get towards the end of the letter, Buffett outlines some of the things he looks for when he's acquiring businesses.
Yeah, he's got a pretty clear checklist. He wants, large purchases, companies with consistent earning power.
Good returns on equity.
Little debt.
Ideally, management already in place.
So he's not interested in fixer-uppers.
No, he wants businesses that are already thriving.
Proven track record.
Makes sense.
He also mentions an interest in purchasing large blocks of stock and convertible preferreds.
So he's flexible in his approach.
Yeah, not limited to just one type of investment.
And then, of course, he highlights Berkshire's AAA credit rating.
Sign of financial strength.
Responsible capital allocation.
It's a testament to his disciplined approach, I think.
Definitely. And his commitment to building, a solid foundation for the future.
That AAA rating is like a signal of stability, trustworthiness.
It tells investors, bondholders, that Berkshire is a company built to last.
And it really drives home the point that, sustainable success isn't built on those quick wins, right?
Right. It's about careful planning.
Thoughtful decision-making.
Yes.
Yeah, it's about building something that's going to last.
For the long haul.
And he even talks about their shareholder designated contributions program.
Oh, yeah, that's interesting.
It lets shareholders direct a portion of, Berkshire's charitable giving.
It's a very unique approach.
It is. It really reflects, I think, Buffett's belief in, corporate social responsibility.
Giving back to the community.
And it also shows his respect for the shareholders, I think.
Yeah, letting them be involved in something meaningful.
Absolutely. Now, of course, no shareholder letter would be complete without an invitation to the annual meeting in Omaha.
The pilgrimage to Omaha.
It's become a legendary event, hasn't it?
It really has, for investors.
And Buffett encourages shareholders to come, ask questions, engage in dialogue.
He's very open.
He is. He promises to answer everything, except for proprietary information.
That's pretty rare, that level of transparency.
It is. He even offers to take shareholders on a tour of Nebraska Furniture Mart and Borsheim's after the meeting.
It's amazing, to go beyond the numbers and actually see these businesses in action.
Yeah. Meet the people behind the brands, understand the culture.
It's a reminder that investing is about more than just, dollars and cents.
It's about people.
It's about partnerships.
So as we wrap up this deep dive into Buffett's 1988 letter, what are, the key takeaways for us in 2025?
Good question.
I mean, it was a different time, different market, right? Are these lessons still relevant today?
Oh, absolutely. I think they are. While the market conditions might have changed, the principles that Buffett lays out, they're timeless.
They are. This letter is really a masterclass in identifying truly great businesses, thinking long-term.
Having the discipline to tune out the noise.
Because it's easy to get caught up in the hype of the moment, right?
It is, yeah. Buffett reminds us that investing is about, focusing on those fundamentals.
Doing your research.
Making those informed decisions based on, a company's intrinsic value.
And perhaps most importantly, having the patience to, let your investments grow over time.
That's key. He's all about that long game.
His favorite holding period is forever.
That says it all, doesn't it?
It really does. Well, we've covered a lot of ground in this deep dive into Warren Buffett's 1988 letter to Berkshire Hathaway shareholders.
We have.
What stands out to you most from this letter?
I think for me, it's that emphasis on long-term thinking, that patience, It's a reminder that building wealth, it's a marathon, not a sprint.
And it's not just about picking the right stocks. It's about understanding the businesses, the people behind them.
Absolutely. It's about having a philosophy, a set of principles that guide your decisions.
Well said. I hope you enjoyed this deep dive as much as we did.
I did, yeah.
And we hope it gives you some, food for thought as you navigate your own investment journey.
Always good to revisit the wisdom of the greats.
Absolutely. Until next time, happy investing.